In this recording I'll explain some of the planning opportunities that might be missed if a will and trust have not been prepared. When someone dies without leaving a will, their money, property and possessions will be distributed according to the rules of intestacy. But this is probably not ideal, as the way the state distributes an estate may not be the same as the deceased would have chosen, and a financial planning opportunity will have been missed. A couple's home is often their main asset. If it's held jointly, they each own 100% of the property, so when one of them dies, the survivor already owns the property, and it's the balance of the estate that's distributed by the intestacy rules. If your health fails, care is usually not free. Whether you receive care in your home or in a care home, it costs money, and when care is provided by local authorities, they are empowered to assess your financial situation with a means test and make you pay towards the cost. A stay in a residential care home will often cost in excess of £30,000 a year, with professional nursing carers costing more, at about £50,000 a year. Often you don't know how long it will be needed, so affording care can be a huge concern. Individuals are expected to meet the cost of their care if their assets exceed £23,250. The family's home is included in these assets. Once assets fall below £23,250, they're expected to contribute towards the cost of their care until their assets fall to £14,000. Finally, once the assets have fallen to £14,000, any income the individual receives will mostly be taken to contribute towards the ongoing care costs. So let's consider an example where a married couple don't prepare a will and they jointly own a property, which is their main asset. On the first death, the home will automatically be owned by the survivor, and the remaining assets are distributed by the rules of intestacy. If the remaining assets are below £250,000, these are inherited by the survivor. Let's assume the survivor's health deteriorates and they enter a residential care home. After any savings have been used up, the family's home would need to be sold to pay for the care home fees. So for many it wouldn't take long for the cash from the sale of the home to be severely depleted or even exhausted. Now let's look at what might have been achieved with a will and trust. You will remember the property was held as a joint tenancy, meaning that they each owned 100% of their home. By changing the way the property is held to tenants in common, they could each hold a specific percentage of the property, and for this scenario we'll assume that each holds 50% of the property, and they make wills, which include trusts. On the first death, the deceased's half of the home, together with any assets up to the value of the nil rate band, would be passed into a trust, and the surviving spouse has the continued use of the property during his or her lifetime. As a potential beneficiary of the trust, the survivor's financial security has not been reduced. Far from it. In this scenario, if the survivor's health deteriorates and they enter a care home, once their estate has been depleted, the local authority will pick up the cost of the care home. The assets from the deceased spouse's estate, including cash from their half of the home, might be used to provide additional comforts for the survivor. So what's been achieved? Less than half of the estate is available for the authority to claim against for care home fees, so beneficiaries will probably inherit a larger estate. The surviving spouse has lost no financial security. Indeed, they could enjoy greater comforts during their lifetime, as they could top up the funding provided by the local authority to pay for a better care home or other events such as weekends away from the home. While the trust could be dissolved, there are benefits of keeping a trust going after the second spouse's death. It's estimated that 42% of marriages in England and Wales now end in divorce. Where assets are held within a discretionary trust, if a potential beneficiary's marriage fails, then any assets within the trust are not taken into account in a divorce settlement. This is because the assets are not theirs by right, as they're only a potential beneficiary. The same applies where a potential beneficiary has creditors. The trust's assets are not vulnerable to creditors, as the individual in difficulty is only a potential beneficiary. Just to clarify, I'm not saying a trust can be used to avoid paying your dues. What I'm saying is that not everyone's relationship lasts, and many businesses fail, and you may want to support a family member while having a trustee oversee when and how assets are distributed, effectively applying limits or controls. There are also tax planning opportunities available with the trust. If you pass assets to your children, they will probably be taxpayers. But by holding assets within a trust and then passing them on to your grandchildren for, say, university fees, tax may be saved, as the grandchildren's income and capital gains tax allowances might be used. So complete the contact form with this video to find out what a trust in your will could achieve.